So hi peeps, welcome back. And this is the foundation video. This is the first video of SFC candle theory officially. And in this video, we're going to talk about obviously the foundation as you can see on the screen. But the main thing that we're going to talk about, because in this video itself, I'm not going to tell you the entry model. I'm not going to tell you the stop loss and all of that. Instead, what I'm going to tell you is something that is even more fundamental than that. And that is the reason why this video is named as foundation and not something as here's how to make money. Because if your foundations are not clear, then you're definitely not going to be profitable. So let's just get into it, okay? So before I teach you anything, I want you to do one thing first. And these are obviously 5 things, but you'll get the point. Go out there and observe these patterns. And what patterns? The patterns that I'm going to just teach you in the video itself, okay? I don't want you to backtest them. I don't want you to trade them. I just want you to just observe them. And that's it. Because the more you observe, the more familiar you become. And if you're not familiar with them, it does not matter how many videos I make. You will never understand them because you won't even know how to actually trade them because you don't know the foundation yet. Now, few of the people on Instagram told me like, bro, this is such a pattern trading concept. And the thing is, every single thing that we do, whether it be smart money concept, ICT, Wyckoff, harmonic patterns, anything that we do is pattern trading. But the thing is, how you trade matters, because if you just see a 3 candlestick pattern and you simply go long, then yes, that is pattern trading. But pattern trading and trading a pattern are 2 separate things. When you're trading a pattern, you simply see a shape, you execute, and then you hope it works because you have no idea. You are purely mechanical. You have no idea if it's going to work or not. You're simply basing it on the probability of the pattern itself. But when you're trading a pattern, that's when you actually get deeper. That's when you actually understand, okay, why this exists, why this worked, why is it forcing the market into certain direction. You read the context around it, you act with understanding, and that's what I call reading and not reacting. So basically in this video, we're going to talk about 2 concepts. The first concept is the base model and the second concept is the SFC formation. The base model is pretty simple, okay? There's a green candle, red candle, green candle, and then there's a red candle, green candle, and red candle. The base model is used as an entry on lower time frame and it's used as a bias on higher time frame. What is a bias? A bias is the view that we have for the market, whether it's going to go up or whether it's going to go down. That's it. What is SFC formation? SFC formation is the base of SFC. And when I say base, I don't mean the base model. The base model is basically the 3 candlestick pattern, okay? SFC formation is the base of everything. And we need 3 consecutive candles in the same direction. In the base model, we don't have any direction. We just have candles. But in SFC formation, we have a direction. Either it could be bullish or either it could be bearish. They had to be controlled. They had to be in a tight formation. They must respect 5 rules. And what are those 5 rules? We'll talk about them in the video. They must be at a meaningful level. And this SFC formation for beginners has to be used only as bias and nothing else. Now let's talk about the base model itself, okay? 3 candle pattern, the base of everything basically. Everything that we are going to study in SFC. Every candlestick concept in SFC revolves around this. Bullish and bearish. Do you notice something? Do you notice a difference in both of these patterns? Yes, there's a difference. The difference is this. Let me just draw it with the pen, okay? We are going to come from a bullish move into this pattern, and then because we have an angle over there and on the lower time frame, you will see that this is actually trendline liquidity, and then we might manipulate this and start going higher, okay? This is what it is. The angle matters. In the bullish scenario, we are simply coming from the top and going to the bottom, and then we are reaching higher. But in the bearish scenario, because we are coming from higher like this, we are tapping into this, we are creating this trendline liquidity lower, and then we are going lower. So the 3 candle patterns, basically the base model, consist of 2 different kind of candles, obviously the bearish candle and the bullish candle. So let's talk about the bullish candle first. The candle 1, which is this one, hangs on top of the red candle. So this is the top of the red candle and this is where it hangs, okay? It kind of hangs over here. And the red candle is the most dominant candle because it's the largest in all of these 3 candles. Remember, first or second candle cannot be larger. If it's larger, then it's invalid. And when I say invalid in this presentation, I want you to understand invalid does not mean that this 3 candle pattern won't work if this height of the third candle goes above the second candle. It just means for you as a beginner, you are not going to trade that. The only thing that you will trade or learn or observe is this candlestick pattern, same right over here, okay? If this is even higher like around here, or this is even lower around here, you're not going to trade that. You're only going to look at this. Moving forward, the third candle is the green candle, which will close within the candle second range. The third candle is the green candle, which closes within the candle 2 range, okay? It has to close within this, and this is also basically close within this, and the second candle with respective of this is basically an engulfing candle. Same thing with there, okay? In the bullish sense, we have 2 bullish candles, and in the bearish, we have 2 bearish candles. That's how you basically remember this. And then candle 3 sits at the bottom of the red candle, which is around here. Candle 1 ideally within candle 2 range 2. This last point basically means both of these ranges have to fall under the second candle's range, okay? And the same thing with here with just the opposite sense. The first candle has to sit on the bottom, the third candle has to sit on the top, and the second candle is the largest, and both of the first and the third candle has to be within the range of the second candle. Second candle is the dominant candle, okay? Second candle is the largest candle in the pattern. Candle 3 must close within the range of candle 2. This means candle 3 is smaller contained by candle. Candle 1 should also ideally sit within the candle 2 range. Candle 3 closes outside candle 2's range, it's invalid. And as I mentioned, when I say invalid, I don't mean that invalid in the sense of a concept, but as a beginner, you are not going to trade that. The middle candle dominates, everything compresses around it. How is it used? So on the higher time frame, the base model, and when I say the base model, I simply mean this bullish candle pattern and then this bearish candle pattern. So on the higher time frame, we use this as a directional bias. And now you might ask, how can we do that? Well, it's pretty simple. Let's assume this is a bullish candlestick pattern which is forming on the higher time frame. Let's say this is a daily time frame or a 4-hour time frame or a 1-hour time frame. And the fourth candle that you expect from this bullish range is a bullish candle. And same with the bearish. The fourth candle that you expect is a bearish candle. Simple as that. So when you see this on the daily time frame, you can expect the next day to be bullish. And if the next day is bullish, then you can go on the lower time frames and look for entries. Same with bearish. On the next day, which is the fourth day, you can expect the market to be bearish. And when the market is bearish, you can go on the lower time frame and look for sell entries. Now, lower time frame entry signal. You spot 3 candle pattern forming. The conditions are met. This is your trigger to enter the trade. You act directly from this pattern. Lower time frame, you pull the trigger. That's about it. Now, about the entry signal, do not act on it yet. Okay, trust me, do not, because in the start, I just told you this, that this is for you to observe. This video is just for you to observe. All you have to do is after this video, go in the market and just observe. Do not do anything else. Okay, do not trade it yet. In a separate video, I'm going to make sure that you understand how to enter these kind of trades, okay? All right, guys. Now, this is an example, and somewhere on this chart, a 3 candle pattern exists. Take a moment. I want you to find out the 3 candle pattern that we just talked about on this chart. You can pause the video because in the next 1 second, I'm going to change the chart. Okay. So here it is. Great if you spotted this, and if not, it's fine because you can rewatch this video, you'll understand what I meant. And now we have this in front of us. So this is the 3 candlestick pattern. So as you can see, this is a daily time frame. And on the first day, second day, third day, we had this pattern. This is exactly the kind of angle that we were expecting, because see, in the live markets, you're not going to get similar thing. Okay, you might get something around it, but not exactly the same thing. You can get it obviously, but not always. That's what I meant. And even if you go back, you can see 1, 2, 3, and the fourth day is bullish. 1, 2, 3, fourth day is bullish. And trading is all about probability, guys. You don't want it to work 100% of the time. We don't want it. We just want it to work sometimes so that we can make good amount of money with it. That's about it. Okay. Now let's talk about SFC formation. Straightforward continuation. This is only used as a bias. Okay. Do not use this to trade yet, because we are going to have a separate video on SFC formation and how to trade it, but not in this video. As I mentioned, in this video, our job is to simply observe 2 things and 2 things only. That is the 3 base model and SFC formation. And when I say the 3 base model, I mean this. You have to observe these patterns. You have to observe these patterns in the market. Observe them and find out and mark them and see what happened after that candle. Now, let's go into the SFC formation. But before understanding the formation, you have to understand why does this formation exist. Now, let's talk about the problem. What is the problem? The problem is, like me and you, we are simply retail traders, right? We are not a hedge fund or a big company that is trading, that is moving millions and billions of dollars around the world. We are simply small people. So our orders get executed in the market instantly. There are lying orders out there which we can simply execute. But that is not true with people who have really large positions. The problem is that large participants cannot buy a full position in one candle. If they do, they move the price against them before they finish buying. The solution is they accumulate slowly, quietly, a little at each candle, absorbing sellers, controlling the move, building without revealing. The fingerprint is that control accumulation leaves a specific mark. Tight candles, controlled opens, small bodies at a meaningful level. That fingerprint is the SFC formation, guys. So if you just give me a second on this chart, then I'm going to explain you what the problem was and how they solved it and what were the fingerprints. Okay, this chart is of Bitcoin daily. This is very important chart. And can you find a SFC formation on this chart? Maybe not yet, because I haven't yet moved the presentation ahead till that time. But here's look at this. Price fell from here. Okay. And when price fell from here, it started to accumulate. It was accumulating over here. And market did not know what to do. It was going down, going up, going down, going up, going down, going up. And then eventually it broke out and people thought, okay, now we are going long, and they started going long. Then eventually market went down and people were like, oh, now we are going down, then let's go down. But notice what started to happen over here after this. So this is the down move, and it's not just any down move, okay? This is the down move after price has taken liquidity till here after price has hunted the stop losses of people who were sitting inside this range and trying to trade this range. And once this happened, then this is a significant move. This took down a lot of traders, and after that price started to reject this, and this is what we call an SFC accumulation. Now before we move forward, let me actually show you how does an SFC formation actually looks like. This is it. This is what the SFC formation actually looks like. One candle forms, second candle forms, third, fourth, fifth, sixth, seventh, eighth. As many candles can form, as many as they want it to form. Okay, there can be 50, there can be 100, as many as they want. The main thing is during the formation, we want to see a tight range in price action, which is slowly moving forward. As you can see over here, tight range in price action slowly moving forward, right? And it started from where? It started from rejecting this fall. So this was a significant move that is going higher. And this is exactly where I told my friends, like, hey guys, this is not gonna fall. It's at least gonna take this high, and then it can do whatever it wants to do. But right now it's not gonna fall. So let's go on to the chart and let's also see how many other SFC patterns are there, how many other SFC formations are there. This, what you see on the screen, is also a great SFC formation. And here's how I'm gonna tell you why this is great. And this is gonna be a little bit advanced because it's just gonna simply give you a taste of what SFC price reading could actually do for you. So look at this. This is the candle which, and I'm gonna now use terms that you might not even know, or I'm gonna do markings that you might not even understand, but you will at least get an idea of what it might do for you. Okay. So this is a 3-candle pattern. We have created a third candle above. We wait for until price start falling, which it fell, and then it took this low. So that means this is the area from where price might fall. Okay, which means this area also kind of become a resistance. But price came around here, fell, and then it came around here, broke above, and then it took support. Now this support, it's a decent thing. Okay, never mind. This was the external liquidity which price took, FVG, okay, price inverse this. Now this is also a 3-candlestick pattern, as we can see over here. Now the third candlestick in this pattern is really important, the close of this third candle. As soon as price taps the close of this third candle while it's coming down, also at this area which is now turned resistance into support, I'm expecting price to move higher from this. And when this happens, guys, what did we saw? We saw an SFC formation coming. So that is why it's very important. Even when I see price go from here to here, I can still long this knowing that we have a SFC formation coming and we yet have not seen a bearish move. Now 1, 2, 3 swing point, and then 1, 2, 3. This is a swing point. So this swing point to swing point is what we call a lag. Okay. Now the 5 rules are, each rule has a meaning and you don't have to memorize these. That's the benefit. You can just simply understand them and you actually start applying it in your trading. So the first rule is open gap rule. Now the beautiful thing about these rules are, guys, this is the reason why I went to the chart first. So now when I'm going to explain you the rules, you'll exactly know what I mean. Okay. You won't be confused like, okay, oh, what am I even talking about? Because there are no charts in this presentation for SFC formation. So that's why I went to the chart. The open gap rule. Each candle opens near the prior close. This continuity is the evidence of intentional control. Look at this, guys. Each candle, see, open, see, close, open, close, open, close, open, close, open, close, open. So the distance is very less in between of them and they're continuously going higher. Even if you mark an angle, they'll keep respecting that angle and they'll keep moving higher. Body size rule. Small bodies relative to total range. Neither side winning. Decisively absorption of both buyers and sellers is happening. Too far closing rule. The candle must not be smaller. The candle must not be similar large sizes in the SFC formation. Eagerness reveals a lack of control. Smart money is patient. Minimum 3 candles. 2 candles can be. See, basically, I'm not going to read these rules. These are like, you can simply pause them and read them, because if I do everything for you, then you're just going to get lazy. And trust me, these rules are something that you will slowly learn in the upcoming videos, so you don't have to memorize them. If you want to do it, you can do it definitely, but this is something you can definitely, learn slowly by time. Now, when I come back to this chart, I'm gonna specify one thing very clearly, guys. This is an SFC formation, but this is an expansion of SFC formation, and this is an accumulation of SFC formation. Then at this candle, this is an expansion of SFC formation. This is the reason why I told you in the start that you are not gonna trade this, you are not gonna backtest on anything, because in this video I'm just making you a little bit familiar about these concepts. Understand, this is still the foundation, it's not the core concepts, it's not the advanced class. So that's why you just have to notice these patterns. You have to notice those 3 candlestick patterns, and the SFC formation. Create beautiful, see, almost picture perfect bearish pattern, and what we got, a bearish move. This is absolute perfection, guys. This is absolute perfection. Even here, absolute perfection with bullish candlestick patterns. 1, 2, 3, fourth bullish. That's it. Price can do anything it wants to do after that. But 1, 2, 3. Okay, this was a semi, like something happened, but at the end we went lower, right? Absolute perfection, guys. So you have to look out for these patterns. You have to look out for SFC formation, SFC formation, SFC formation. Okay, these are SFC expansion, but at the end, as a beginner, just focus on these patterns, these two things: SFC formations and these candlestick patterns. That's about it. Now, SFC formation versus consolidation. Now, I have a perfect example for this slide. Okay, perfect example. I've already shown it to you. This chart of Bitcoin over here is a perfect example for this. We gave such a massive move and then we started consolidate over here. What you can see here, like there is no SFC formation. There is no 3 candle pattern which is reliable. Like there's nothing in this consolidation. We are like moving in, moving out, moving in, moving out. There is nothing as such in this. But as soon as near this consolidation, we started doing SFC accumulation and then only we gave an expansion towards the upside. So you can see predetermined, direction is predetermined, one side is loading and the direction here was bullish and one side was loading and then it went higher. And consolidation is basically random, it can break from either way. It has no story, okay? I mean, the consolidation has no story. SFC formation has a story. Prior to participants, what did I told you here in the video? Market took the stop loss for a lot of people over here, a lot of sellers, and then started moving higher. People thought, okay, it's gonna go higher, and then it went lower, and then only after that we started seeing accumulation, SFC accumulation. So this is the story behind it. But if you just look at the consolidation, then there is no story. There is no story whatsoever. Okay, I actually forgot to add a chart over here, but I'll just go on TradingView and I'll show you what I meant. So I want you to look for SFC formation on this chart. You can pause the video right now because now I'm gonna start speaking facts. So we have an SFC accumulation right over here. Here we have an SFC accumulation. We create an angle on this SFC accumulation and we hope that price will not break it. If it does, then we look for moves. Here we have this 3 candlestick pattern which was bearish, expecting prices to go lower, but we did not went lower. That means this now becomes a really good support. And how did that support actually reacted? Well, as you can see over here, this support reacted really nice. So we could have gone long over here after simply inversing these fair value gaps, putting a stop loss over here and simply targeting either 1:2 or maybe what I'd like to target, that is 1:1. And I just showed you how to trade SFC accumulation, but just like 5 to 10% of it. So don't actually do it, but just understand how you can use this. And this was a little bit complex. That is why I give you this example, because SFC accumulation in this chart was not actually clear. Only this section was actually clear. Like only this part was something meaningful for you guys. And this is something advanced. And then this is obviously like super advanced. Here it is. Oh, let's go. I already showed it to you. Now let's do the summary and let's talk about what's the difference between the two. The base model, the 3 candlestick pattern. One is green, red, green, and the other is red, green, red. So the one is that is green, red, green is bullish, and the other one is bearish. Candle 2 is the largest candle. Candle 3 closes within the range of candle 2. Candle 1 also closes within the range of candle 2. The direction is alternating color. So if like we have green, green colors, like green, red, green, then the direction is green. If we have like red, green, red, then the direction is red. Simple as that. So basically in bullish, we expect the direction to be bullish in the 4th candle. And if it's bearish, we expect the direction to be bearish in the 4th candle. Then for entry, we simply go to the lower time frame, we look for entries. Higher time frame, we look for directional bias. And the meaning of that is like a decision is being made now. So like first 3 candles have actually told you what price might do. And the 4th candle is actually going to do it. So you go on the lower time frames, you look for bullish scenarios, you look for bearish scenarios getting disrespected when market is actually bullish, and then you enter that trade. Now talking about SFC formation summary, the pattern is we at least need 3 consecutive candles in the same direction. The candles need to be of the same color, obviously. It cannot be like green, red, and green, or green, black, and green, which I have in this case. It cannot be like that, okay? It has to be either black, 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 or green, 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 green. And the control is we need opens, like tight opens, small bodies, like longer wicks. I haven't wrote it yet, but like we need longer wicks, because from my personal experience, I have noticed that the longer the wicks, the better the SFC trading pattern is. So over here, we took this, we started going lower, but then we're like, nope, we're not going to do that. And we started creating longer wicks, because this is, price, like institutions accumulating positions at this price level, like at this range, I would say not even level, but at this range, they're basically opening in this particular time, in this particular day. If I say they go up and they come down, they go up, they come down, they go up, they come down, or sometimes they would go down and come up. They're basically, from all this range, they're basically accumulating positions, and then they're going higher after that is done, after they have actually set a target, which is around like here. And then there are 5 specific rules, which you don't have to care, to be honest. Just don't care about them. Eventually you will learn them. The location is very meaningful with the story, and there is no such entry. I haven't taught you about the entry, except for I just give you an example earlier. And the high time frame, like you only understand with this as a bias. So for example, if you see an SFC pattern, if you see an SFC formation that is bullish, then you simply are looking to take longs, you can go on the lower time frames, you can look for long entries. That is basically a trend, okay? That is SFC formation is basically a trend. It's like price is going higher, 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 higher. So on the lower time frame, you simply look for retracements, you enter that, and then boom, you make profit. So before the next video, I want you to do this. I want you to open any chart, any market, any time frame, gold, Bitcoin indices, doesn't matter, truly doesn't matter, and look for the base model only and look for SFC formation only. Do not look for entries. Do this for 1 hour and do this for as many days as you possibly can. Now, why I want you to observe before you trade. So pattern recognition has to be internalized in you, okay? You have to, when I'm teaching you this in future, new concepts, you have to be like, okay, I can recognize this pattern instantly. When you are in the charts yourself, you have to be, okay, I know what pattern is he talking about, or I know what pattern is kind of forming. Reading about it, it's not going to do anything. Watching me point at it, it's not going to do anything. You have to start finding it yourself. You have to start doing it for yourself. And that's how you're going to get really good at trading. Now, once you learn that, once you are able to find these patterns, okay, that you have never seen, and now you can simply look at chart and be like, oh, there's an SFC 3 base model. This is the bullish one. This is the bearish one. Oh, there's an SFC accumulation. Oh, there's an SFC expansion. The moment you can do all this is the moment you're ready for the next video, which is going to be how we use these formations to trade, the model, the entry, and the condition. So this was it about, guys. Like, this was it, to be honest, the video. And in this video, I didn't show my face because, as I already told you, that I was traveling, and I'm still traveling, by the way. But I was like, okay, I have to make a video. I have to post a video for you guys out because it has been like almost 2-3 days, and a lot of you people are messaging me, and I'm so grateful for you all. I love you all, honestly, and keep supporting me like this. And this is gonna be an insane trading methodology in the future, and you are a part of it. You have to be very proud of it and practice this as much as you can, because we are gonna be next best traders in the world. And let's freaking go, guys. Let's freaking go.